Michael has been a presenter at lots of AAMA national events, lots of Southeast events. He probably has a stat of how many presentations. I always find them fascinating, really great information on trends in the industry, M&A activity, the import activity, and then lots of other housing trends. He usually has good news these last few presentations, so we'll see if that holds true with this. And I'll just give a quick bio because there are some folks that haven't yet met Michael. So our next speaker is Michael Collins. He's the managing director and co-founder of Building Industry Advisors, a building products-focused investment bank headquartered in Chicago. Mike leads his firm's efforts in the M&A activity and capital placement for companies in building products industries. His practice is particularly focused on the window, door, and glazing segment, an area which he has conducted extensive research. Mike writes regular blogs and articles for the industry publications, including Door and Window Market and Pro Sales. Mike has been addressing AAMA meetings since 2006, and we're very pleased to have him address us again today. Thanks, Michael.
Thanks. Thank you. Well, thank you for having me, and I do in fact have a statistic as to which AAMA meeting this is. This is my 16th AAMA presentation. So obviously, if you do the math on speaking since 2006, that means that some years I do one presentation and some years I do two. And I sort of marvel at how I was able to even come up with presentations during the downturn, because so many of the statistics were going in the wrong direction. And it's wonderful to be back sort of on the other side of all of that and have a lot of good news to share and a lot of statistics that are headed in the right direction. And as Dean said, I will cover today a sort of a macroeconomic overview. We'll take a look at some statistics and some trends specific to the commercial segment, the residential segment. We'll look at some window and door industry trends, and then we'll cap it off with some capital markets activity, mergers and acquisitions activity. That's always a good indicator of the health of an industry segment, and that's definitely the case in the window and door industry. So starting off at the high level of the macroeconomic view, we always look for a job creation level of around 200,000 jobs per month in this economy in the United States. The number doesn't apply to other countries, but based on our population and our economy, a 200,000 job per month creation level is indicative of a self-sustaining recovery, because those folks get hired, they spend more money, that leads to more jobs. And so every month when you hear that jobs report, it's always interesting to know whether or not it met expectations. That's one way to measure the jobs report. But the other way is to measure the absolute amount by which it fell short of or exceeded 200,000 jobs created, because that's the part that we're looking for. Labor force participation is at an average of about 63%. That looks at employable adults and how many of them are taking part in employment and being part of the labor economy. And there is a sort of a strange nuance to unemployment statistics, where there's what they refer to as sort of shadow unemployment. Because technically, to be counted as unemployment, it's not just that you have a job, but you're actively looking for a job. So when they do the surveys that feed into the unemployment statistics, they ask two questions. Are you working? No. Are you looking for work? Yes. Well, then you're technically unemployed. When that person becomes what's called a discouraged worker and they stop looking, and the answer to the second question is, no, I don't have a job, no, I'm not looking, the good news is you're not technically unemployed anymore, although you still don't have a job and you no longer show up in the statistics. So there's a sort of a false view, but in this case, the economy is so close to full employment now at a 4% unemployment level. That's really what we refer to as just the normal frictional level of unemployment that our economy is going to have at any given point. There's never 100% employment, because John or Mary gets a job in another state and then they move and they're temporarily unemployed for a short time. Now, 2016 is going down as an interesting year in this recovery, because so far it's been the weakest year of growth. We saw about 1.6% GDP growth in 2016, and there is a certain, pausing in an election year to sort of see who comes into office, what policies do they have. There were projects that got put off. I don't know if John and Mary homeowner put off, changing out the windows in their house over an election, but certainly any major size projects, there's a definite pausing in any election year, and so we've seen some of that. But then we've got projections of 2.5% GDP growth going forward, which is more normal for our economy. So then the question is, well, sort of this expansion, how long can it go on? And I'm going to talk about this in a little bit more detail in a later point in the presentation. But for right now, this recovery in terms of the trough to the next peak, where we're at right now, we're 93 months into this recovery. And you can see here that in the past, these recoveries had barely made it over 100 months of trough to peak recovery period. So you start to wonder how much runway is left. We have a lot of reasons that we think there actually is quite a bit of runway left, and that we have a few more years of growth in front of us. And this will be one of the longer recoveries, if for no other reason than the fact that it was one of the longer downturns and a longer, steeper, shallower downturn than most of us have seen in our lifetimes. In terms of mortgage credit conditions, we're at a point where, according to the Senior Loan Officer Survey, we're in a net easing situation. So obviously anybody that sells products that are related to the residential segment benefits from mortgages being easier to obtain. But the beauty is that they are not as freely obtainable as they were in the downturn, and certainly and particularly in the period that led up to / caused the downturn, where you had folks paying an extra % or 2% on a loan in order to not have to undergo income verification. And so they were taking on mortgages that were far in excess of what they could truly afford. And it was predicated on the idea that, no problem buying this $600,000 house you can't afford, because next year it'll be worth $700,000. You'll refinance the mortgage. You'll pull $50,000 in equity, put it in your bank account. You'll still have $50,000 in equity in the house, and then a couple years later you'll do it again. And from my standpoint, I was in this industry as an advisor during this recession, and I was a stockbroker during the dot-com blow-up. And I see a lot of similarities in those two periods of time, because they were both based on an underlying belief that an underlying asset could only go up in value, and so that you should be aggressive about using debt to acquire that asset. And the same thing happened in the dot-com era, and the same thing happened in the housing crisis. Dot-com, it was those companies. Housing crisis, it was the value of homes. And assets don't go up in value in a straight line over time. And so the fact that right now mortgages are easier to get, but not just being thrown out the window, so to speak, is good for this economy, and is a sign that we look at that the next soft patch will be a soft patch and not a blow up like the last recession was, because those false mortgages aren't out there being extended right now. The labor market, unfilled construction jobs is one of the areas that we look at. Home starts go up and down and flicker based on weather and the length of the month and all kinds of different factors that you have to take into account. But when you've got construction jobs that are unfilled, and there are many, many tens of thousands of them, and that persists over time, those aren't people looking for part-time labor for 2 months to help out because things are busy. Those are permanent hires that people need to meet the demand of getting these projects completed, and those jobs are not being filled right now. Some of those folks were working during the last recession, lost their job, got to the age where now they qualify for Social Security. A lot of them have their homes paid down, and they have a sort of an equilibrium financially in their life, and they don't have to come back to work, and many of them have chosen not to. So there are different industry segments where they're not getting the workers to come back, and construction is one of them. So that's a definite challenge for the industry. Here's a little more detail on that hiring level aspect that we talked about. March, we did not hit that level. We only got to about half that level that we want to see. But in both January and February, we handily exceeded that 200,000 jobs level. And if you scroll this back to months last year, there were many months in 2016 when we also hit that 200,000 jobs level. So we're seeing a sustainable level of hiring and new job creation going on in the economy, which is extremely positive. Now we'll take a look at the commercial market and some just high-level statistics that we zero in on there. 5.7% growth expected in institutional construction next year. There's been sort of a pent-up demand in institutional educational areas. We've got a population bubble moving through our society that is similar to the baby boomers, in that they're consuming services and different types of things as they age and get older. And there's a high demand for university buildings that's starting to come back that had been kind of tepid for the past few years. Construction employment, we've already really covered, hit a peak recently where there's 150,000 construction jobs added in 2016, where in past years we were shedding those jobs. And then just general employment has increased, which of course supports things like office buildings. And you're starting to see, we work with companies that build office buildings in city centers, and there was sort of a trend where all the millennials wanted to live downtown, and they were willing to live in these, tiny apartments if that meant that they could be downtown. So all of a sudden, all the corporate headquarters that were built out in the suburbs had that oh no moment where now all of a sudden they're supposed to be downtown. So in places like Chicago and other areas, we're seeing buildings going up downtown to accommodate the fact that these millennials want to live real close to work. Well, then that leaves these office buildings out in the suburbs, and then somebody comes along and sees that and says, you should spruce that building up. That'd be a great corporate campus. And so now there's the second wave of refurbishment of office buildings out in the suburbs. And so we sort of raced back and forth in and out of the suburbs and the city centers based on preferences of the workforce. But the point is that it will lead to construction in downtown areas, and it will lead to a refurbishment cycle out in the suburbs. You're not going to draw somebody out there in a sort of a drab Class B building, but if you can take maybe a B plus building and make it an A or an A minus, that's going to draw people back out to the suburbs and create that refurbishment cycle. So that's a benefit to everybody in this room. An interesting aspect of the commercial, as we're all aware, it tends to lag the residential cycle by about 12 or 18 months. So all of this good news that is happening in the residential area and the strong building levels and so forth, that will have an echo a year to 18 months from now and continue to reverberate for the next several years in the commercial side and be a benefit of on the commercial side of things. Now, oil prices were driving the economy at 18 months, 2 years ago. There were a lot of wells being started and restarted, the Bakken Shale, all that. That area was exploding. It's had a great benefit for cutting down on the amount of oil we have to import from other countries. But now they've sort of turned the spigot on in some of those other countries that produce oil, and so oil prices have dropped, and a lot of the wells have been shuttered. But it's important to note that the wells that have been shuttered, there's that sort of invisible hand out in the market that causes the most efficient businesses to persist, and the least efficient marginal businesses that didn't have their cost models down, or maybe they weren't in the best production area or had the best production techniques, those were the first wells to get shut off because they were the least productive. So now some of those that were marginal have improved their operations, come back online, and we're the better for the fact that they're now producing oil at a cost-effective level. So you've seen some of those wells slowly and gradually come back online. Generally, as the economy improves and oil prices come back up, oil production will pick up in this country again, and that will be, again, a key component of our economic growth. That's the other part of the reason that some of that vacuum and slowness in 16 was created by some of these oil companies slowing down production a little bit. Taking a look at commercial construction, the projection, again, 5-6% a year growth. It's not anything that looks or feels like a bubble. It's the kind of environment where there's plenty of opportunities out there, plenty of opportunities to grow, and should be a very good environment for the next few years for the types of companies that are in this room. Again, looking at the non-residential market by size, and all of these slides will be made available, so you don't have to feel that you have to take notes on these. You break it down into different segments: hotel, retail. Retail has some unique challenges with online shopping. There's that whole brick and mortar presence is not as much of a guaranteed thing that that you have to have this great retail presence, and then you've got to build one in the next city and the next city in order to succeed. The model is different now. Maybe some of you also step over a Zappos.com box every night when you come home because more shoes have arrived. My wife is shotting a small army of children somewhere, I'm confident, with Zappos.com. And, that means that there's less pressure on that retail presence where we might have all gone to a retail, environment and get our shoes as kids. Sort of don't do that anymore. The retail showroom's in your living room because the products come and they go, and it sets some pressure on retail, storefront and products like that. But generally, when you look at the projected growth, the only kind of tough areas are in manufacturing and religious structures for the next 2 years, that the growth is projected to be somewhat tepid. But in all the other segments that are heavy architectural segments, and not just aesthetic architectural, but now starting to get into blast resistant and bullet resistant, and our definition of vulnerable targets that need to be protected with special fenestration products is broadening, unfortunately, every year. And so companies in this glazing and fenestration segment have an opportunity to help solve some of those problems and provide products that keep, not only a high aesthetic standard, but a high safety standard in these different segments. And that's where that growth is coming from. Taking a look by the segments themselves, you can see that there's a general expansion, and then certain of the blocks in the stacked chart here are growing faster than others, schools and colleges being one. Hotel is strong again with the employment picture. So the point is, almost regardless of the segment that you serve, you'll see good opportunities in the next few years. So turning to the residential market, taking a look there, consumer confidence, obviously, in the residential market is always important. Employment figures are important because if John and Mary homeowner come home night after night and all they're seeing is layoffs and layoffs and layoffs, and there are layoffs at the company that they work, that's not the year that they're going to say, you know what, let's redo the kitchen and the back, patio door, let's put that sliding door system in. They're not going to do all those things. Even if they themselves may be financially secure, there's a general feeling of, economic worry that existed during the downturn that kept those projects from happening. Well, that's not the case anymore. Now there's a lot of confidence. You're not hearing about layoffs. You're hearing about hiring. And so people, consumer confidence is up. It's double what it was during the downturn, which is significant. Home affordability is also high right now. Home prices are climbing up in certain markets. But if you look at the reason that that's taking place, it's not a bubble. It's not that false demand has been created and people have become potential home buyers by being given a mortgage that they really can't afford, and now they're buying a home and that's chasing the price up for the next person who maybe could have afforded it, and now they've got to bid up on the next house and so forth, and it's a self-fulfilling cycle. This increase in pricing is more driven by a shortage of supply than false creation of demand. And when there's a shortage of supply that's creating it, the market will find ways to make that go away, meaning builders will work extra hard to get their projects approved, which we'll talk about that challenge in a bit. It will right itself. The false demand problem has to end in a pin hitting that bubble, as we all saw painfully last time. That's not the reason that's causing these home prices to go up. It's the national home score is at 60 at the end of last year, which means that 60% of the homes across the country were affordable to the people that are at the median, meaning 50th percentile, half are above and half are below that level of income in that community. And so that lets you compare homes in the very different markets like Indianapolis and Los Angeles. The homes in Los Angeles are more expensive, but the income levels are higher. And so it's a question of, can the people in that area afford the homes in that area? And the scores are very good in that regard right now. If you take a look at existing home sales, there's a very low inventory of existing home sales. Some of these charts, when I used to come to AAMA presentations in 08 and 09, I wouldn't have dared show these charts because they painted such a horrible picture. Trace the line back, the existing home sales back in the downturn snuck up to 10, 12 months supply. Now you're looking at just 4 months supply. So home sales are going up, inventories of homes are going down. That's the perfect scenario to have in a market where you're a builder looking to build additional homes. You want to know that the inventory is being taken up and that home sales are being completed and there's not this huge inventory piling up. Because as much as we all prefer a new home, if the price of an existing home is compelling relative to a new home, people will pursue that avenue. So you don't want to be priced out that way. Now, in this case, you look at the, this chart is shaped at the end a little bit like a scissors, and it's sort of the homeowner that gets scissored in this scenario because you've got lot sizes decreasing. So if you want the same size home, which in a minute we'll see that homes have actually gotten bigger, you're sort of swelling to really fill up that lot size. So the lot size is getting smaller, and the cost of the lot size is going up. Now that's the wrong side of the problem to be in, and you start to see builder magazines and things like that talk about, great house plans for an odd-shaped lot. Basically trying to just shoehorn houses into those B-minus lots, and that because the A lots are all taken, and then B-minus is the new A lot. That's sort of the best that you can get. So I referred to this earlier. One of the challenges in the industry right now is the regulatory environment. And, there's some hope, and I guess maybe it was the simplest way that I've heard it put, but very, very elegant in its simplicity is, we've got the Trump administration in place now. The statement was, the man's a builder. How much is he going to do that's bad for building? So you look at that, there's the hopefulness that some of the regulations will be eased. There's some water regulations that have been eased in the past few months here of the beginning of the administration. But in general, over the past few years, the regulatory costs have climbed, and you can see it's a swelling portion of it that's during development. The regulatory costs during development are up 29%. And you're starting to see cities that got burned the last time by that developer that maybe pushed a road through an area to start getting ready, and then they paved it, and then they put the first couple of houses on it, and then they ran out of money in the downturn, and it sort of stopped. And you have this truncated development, or there's places where there's dozens of basements sitting there and there's no home on them, or things were sort of stopped in the middle of everything. And so some of these cities are requiring now that the builders finish out more of the area first, so that they can demonstrate, quite frankly, that they have the financial wherewithal to do that, and the city's not going to be left with a half-finished neighborhood that creates a lot of challenges for them. So that's part of where that regulatory cost is coming from. Just another way to take a look at the housing market. The housing market index is up even more steeply than the single-family starts themselves are. So that would indicate good strength in the market, good pent-up demand, kind of that compressed spring that has room to just continue to run for the next few years. So that's nothing but good news for people that focus on the residential segment. Taking a look at single-family starts, we're looking at the NAHB's projection of about 900,000, 860,000 for 2017, and then just shy of 1 million in 2018. And we get asked quite a lot, well, in the downturn we were asked, when's it all going to end? When's this going to end and we're going to pick up again? Now, folks will still ask, well, when are we going to get back to where we were before? I don't know that we are in the short term, because so much of that was false mortgage demand that in a more efficient, orderly market wouldn't have existed. That was game playing and overextension of credit when the risk being taken on by those financial institutions exceeded the benefits that they got for it. So I don't know that we're going to get back to those levels in the short term. The point is that the levels we're at right now and the levels of growth we're projecting are good, solid, sustainable levels that don't ever have to be a bubble that bursts. So the next soft patch can be a soft patch and can be more like the downturns that we saw in the past, which when you see them on a chart look sort of like a fang. They're a quick drop and a quick spike right back up. And if you remember the way recessions used to be, it was almost like a joke, like, it turns out we've been in recession for the last 6 months, and by the time it was even official, you were practically out of it, and you didn't really feel it. It wasn't this long, lingering, terrible thing that we've all dealt with here. Typical home size is an aspect where during the downturn, home sizes dropped out of necessity. Folks were building and buying the homes that they could afford. And there were a lot of reasons that went around of why that was going to be a permanent trend and so forth, and I just never intuitively believed that, having traveled to Japan in the mid-1990s when I was in college. And one of the first things they taught us when we got there was the phrase for rabbit house. I thought, why do we need to know how to say rabbit house in Japan? And what had happened is that there was a reporter in the 80s that went to Japan and studied the Japanese people, and he came back and he wrote an article and he said, well, the Japanese people are workaholics, which they took as a high point of pride, and they live in rabbit hutches, which they took as a deep, wounding national insult, so that 10 years later, when you go to a house in Japan and meet someone and see their house for the first time, there's about a 50-50 chance they're going to ask you what they think of their rabbit hutch. That's how wounding it was to be told they live in small houses. And nowhere in the world is that more prevalent than in the United States. We like our houses big, we like our cars and trucks big, and so it just made intuitive sense that was not going to be a permanent trend. Lo and behold, it's come back strong, and house sizes have gone up. So that's a benefit to everybody in this room, because every 30 or 40 square feet of home space that gets built is just more windows and doors that you need for egress and aesthetically. So that helps everybody in this room. Now, the multifamily market had such a strong run-up, and it was stronger even than single-family, because you had all those folks that were dislodged in the downturn that sort of did what they had to do, moved back home, did all kinds of things to just get through that period. And then they don't tend to come out and just buy a new home. They tend to get into a multifamily situation first. And so the multifamily market grew more steeply than single-family. So now it's sort of pausing for breath. It's not going to crash, but in the next few years, it'll have modestly negative growth, just basically flat for the next few years, but still an important segment. Total housing starts, again, if you look at this chart, you see that beautiful strong run up. We all like that. if you draw a trend line through the midway point of all those mountain peaks and valleys of growth in the past, you'll see that we're just barely hitting that. So by no means are we overextended. By no means is this a bubble. And there's no reason to think that this recovery doesn't have a few more years of very good growth ahead of it. Remodeling, same thing. Remodeling and new construction tend to ebb and flow. There's been such a pent-up demand for new construction that now that people can get mortgages again, they're out doing so, and you're not seeing remodeling being as much the driver of activity for folks. Although people that have been burned in the downturn are very definitely careful to keep their relationships with remodeling dealers and contractors and so forth, because when that new construction slows down and people make the decision for whatever reason to stay in the home they're in, the first thing they're going to do is turn to thoughts of remodeling it. And then the precursor to the next run-up of people selling homes is let's get the home fixed up in order to get a better price when we sell it. So remodeling will always be important to this industry. Good growth, 4% this year expected, 2.3% next year. But don't burn those bridges with those remodelers, because that's a big safety valve in this industry. So taking a look at some of the trends that are specific to the window and door industry, glass shortages remain an issue. There were a lot of glass facilities that were shuttered during the downturn. They are multi-$100 million facilities to build now because of the technology and the scale and scope that they have to achieve in order to be able to compete with international glass suppliers. So it's not the kind of thing that you can just, I'll just rent a warehouse and start making some glass there. It's a major commitment, and so they tend to, those commitments tend to be made very slowly. When we see companies winning customers, one of the key ways to be able to win customers right now is to beat the lead time of the other supplier. If you just have a good relationship with your glass supplier and maybe they're lower on their glass supplier's list, all of a sudden you're able to shave a week or 2 weeks, 3 weeks off of predictable lead times, and you can win new business that way. In the commercial glazing and large project segment of curtain wall, we're hearing about groups that have 6-month lead times, 8-month lead times. And then sometimes they're calling right as the promised lead time approaches to say, hey, need another month. And that's can be very challenging when you're trying to close in a structure, particularly if winter is coming. Taking a look at again, the labor shortage, the labor shortage hits window and door manufacturers in two ways. Number one, you've got to have people working in your plants to produce products for you. Number two, you're trying to sell products to builders who are also having labor troubles. So they're calling you, telling you, hold those windows for me for 6 weeks. I can't get my next building finished out. I need to start on the next one because they can't find people. So there's this sort of double hit that we take in this industry. And so that leads to emphasis on being the solution for your customer of that problem. It leads to more emphasis on things that are modular, unitized, built in the factory and shipped out whole to just be installed in place. If you're not focusing on those kind of things, then you're missing a massive cyclical opportunity over the next 10, 15 years that builders and people like that want you to be part of their labor solution. Quite frankly, a lot of times you're trading field union labor for plant non-union labor, and there's a huge benefit there that the customer and the manufacturer get to share. So that's a key aspect to remember. When Donald Trump addressed the joint session of Congress, it wasn't technically State of the Union because it was his first, so it's a joint address. He talked a lot about the infrastructure program, talked about it all through the campaign. And so, we'd expect to see announcements on projects and things like that. On one hand, infrastructure is great because it tends to be, only positive for the building products industry. But on the flip side, related back to that labor issue, once they get these massive infrastructure projects that start to need people to swing hammers and do things at those projects, it's going to have the same effect that it did when the oil fields took off and they started pulling all the workers there. I don't suspect the wages will be quite that out of line with the market, that it'll be that strong a draw, but it will very definitely pull some folks away from manufacturers and builders and create its own set of problems and labor challenges as well. So it's sort of, you get one benefit out of it, but it's got a cost as well. We're watching this Energy Star situation. There was some language in his current budget that says that the EPA needs to transfer the ownership and implementation of Energy Star to a non-governmental entity. Now, the notion of a non-governmental entity policing and setting standards for an important aspect of industry is not scary to anybody in this room, because you folks are here to do that very thing. And you're proof positive that an industry can responsibly set standards for itself and is An industry is closer to the doing of its own business than any government entity can be. So I don't think any of us have any, inherent fear of the notion of Energy Star changing. But just from a businessman standpoint, when you look at an 85% brand recognition that emblem enjoys, that people know what that means, it would be a shame to see that go away. So whatever happens, it needs to be something where that Energy Star brand is kept in place, and maybe an organization like this is created to set standards associated with it. And so I throw that out for your consideration as you're making your plans for the future. That's something we should all be a part of, so that we can still differentiate one product from another that's taken some extra steps to be energy efficient. So the question that we raised at a recent presentation that I moderated on the distribution side of the building products industry, one of the longtime veterans of the industry had made the statement that he felt that the recovery was in about the sixth inning. And so I thought that was an interesting way to look at it. And so I posed the question at that conference, gee, are we in the sixth inning? What does it feel like? And the consensus was, yeah, everybody that I've talked to, yeah, it does feel like we're in about the sixth inning. But this is going to be an extra innings recovery because the decline was so long and slow and painful, and the recovery was so slow where they're normally so fast, that this is a recovery that's going to last a lot longer than others in the past. So while we've been at this a while, again, to keep beating that drum, we've got a long recovery still ahead of us. Multifamily is probably in the eighth inning. If we're all in the sixth inning generally, multifamily residential is probably in the eighth inning. But again, still good. And certain markets, you could say Chicago or Detroit, markets that have lagged the recovery might be in a lower inning, and markets down here in the southeast that have done better probably in a slightly ahead of that. Question: we've got interest rates that have increased, and then we've got more rates that are potentially coming. When the cost of a good increases, all other things being equal, the demand for that good should drop. So I can't sit up here and say that interest rate increases are good for residential activity, because they technically should only be able to be on the negative side for it. But when you look at what an interest rate increase means about our country, it's probably a good sign, because what it means is that the Fed feels that the economy's doing well enough that it can raise rates and not cripple the economy. Where when they first floated the notion about raising rates a few years ago, that was met with heavy backlash because we were just getting back on our feet, and that's the last thing we needed, so they left it alone. So they've done a good job each time they've raised of signaling, hey, by the way, we're going to raise again, so the market prices that in, and you don't have bond market crashing because they do an announcement that's unexpected, or like 1994 when they raised rates 7 times, and that was considered, made everybody very nervous because you never knew what was coming next. They've done a good job of telegraphing their intentions, and if you think about it, when interest rates are effectively at 0%, the Fed has lost a very important tool of stimulus for the economy, which is cutting interest rates. You have to have rates above 0 for them to ever be able to cut them again. So it's positive for them to creep up, and then when we do hit that next soft patch, if they can cut them back a percent and keep, spur things again, that's a helpful thing. If they keep them at 0, they'll never have that ability again. Another question that's come up with the change in the administration is sort of the immigration status. What is the change in immigration? What we're starting to see is that companies that are looking to acquire other companies for the first time are not just saying, it was always historically a due diligence item to make sure that they had I-9s, Form I-9s on all the employees. Everybody's got a Form I-9 filled out. Well, there was a lot of sort of wink-wink aspect about that I-9, that if they came back as being not good, they'd give it to the worker and say, oh, I think you wrote your number down wrong, and come back the next day with a different form filled out. There's not going to be that anymore. A lot of more companies are focused on using E-Verify, which is a more rigorous system. And quite frankly, as an acquisition is one example of when this really comes to fore. When you're going to buy a company, you tend to be buying the assets, and you're setting up a new company and hiring all those employees and moving them over. Well, that intervening filter says if you don't E-Verify everybody, anybody that can't pass through that filter doesn't come over to the new business. So all of a sudden, a company goes through a total cleansing of E-Verify compliance at an acquisition, and sometimes they lose really key people that the employer really didn't know weren't documented workers. And so it's a real issue And so to the extent that you ever think you're going to go merge with somebody or take on debt or any of those types of things, it's becoming much more prevalent to need to demonstrate that all your workers are documented with that E-Verify status. In terms of building products M&A in general, this is not just window and door specific. This slide looks at across all the spectrum of different building products. You can see that activity has increased to pretty high levels over the last couple of years. It's been very active. That's a good sign for a given industry that outside capital, theoretically smart money, is pursuing opportunities in that industry. That's very good. We take a look at specifically window and door merger and acquisition activity. You can see that it peaked in 2007. That was the height of the market. That was when things looked great, and we didn't know that they looked great, partly based on false mortgages and the activities there. The problems hadn't really come to fruition yet. They came to fruition in 8, 9, and 10. A lot of the activity there was need-driven, meaning we're not going to survive, we need to be bought. We did a lot of deals in that era when you were effectively, metaphorically, you were on the courthouse steps selling those assets because there was a debt issue in place and the bank needed that worked out. And activity kind of paused and just drifted downward over time as people didn't want to be selling on a downstroke. They built this company 30 years, that sort of thing. They wanted to, profit from it. Some folks put money back into their companies during that era, significant millions of dollars. Some of them lost that when the company failed. Some of them, it turned out to be the best investment they ever made in their own business. And the company came out of the recovery period extremely strong, well capitalized, and ready to accelerate, and that's what's happened. So 15 and 16, you saw a good surge. A lot of those were folks that probably wanted to retire in 08 and 09 and just stubbornly refused to sell when the market went down. And as soon as they had some good black ink trailing behind them, there was some good selling activity. We would expect it's always slow in the beginning of a year because deals tend to want to get done by the end of a year. And right now there are people out there planning and starting and selling processes are going on. And we'll get those announcements in the fall and in the winter. Deals tend to get come in a burst at the end of the year. The point being that the demographic in this industry is an older demographic among owners. There will still be a lot of M&A activity over the next few years as those owners want to retire. Now, plant expansions tell a different story. 2006, we had 28 plant expansions in the window and door industry in the United States. 2008, we had 28 plant closures. Now, obviously, most of those were different plants, but believe it or not, a few of those were the same plant. Came online in 06, closed down in 08 because it was the least dialed in, least utilized plant within the system. We had just a massive amount of wealth destruction. The green bars on the bottom are closures. The expansions and openings stopped to a halt. The closures kind of fell to meet it, and we hit an equilibrium where not much happened. We're just now starting to see expansions again and almost no closures. So that's a great dynamic for an industry that's in recovery. You're not still seeing plants being closed and shed. As if anything, right now we're starting to run into companies that are constrained in their main facility and starting to look again at expansion. So we'd expect expansions to pick up in the next couple of years. And then bankruptcies and closures, same thing, 08, 09. We didn't even track them before then because there just weren't any. There would be quirky little things where somebody got into a product problem or who knows what, but there just were hardly any. We had a huge amount of closures in 08 and 09. Sadly, in 2011, things were starting to get a little bit better then, but what you saw was closures that were almost sort of driven by the recovery itself. You were on fumes coming into 2011. Things started to get better. Orders started to pick up a little bit, and you just didn't have the working capital or the debt bandwidth to profit from it, and poof, those companies went out too. Then that dropped off. Some years, 13 and 15, we were not aware of any bankruptcies or closures, and we had one each, one so far in 17 and one in 16. So just, again, a very healthy environment from the standpoint of bankruptcies and closures. In terms of the cycle timing, again, M&A appetite, are there companies still out there buying? Absolutely. The profits from the last few years have built a war chest for some of these companies. They're out there buying. There's been a lot of activity in the Southeast here, a lot of acquisitions that have happened that you're all aware of, and that's just driven by debt availability and the availability of cash. And the fact that when any company of any size has to make a decision when they have cash, is the best use of this cash to distribute it to the owners, whether that's just a private owner taking a distribution that no one is aware of, or a public company doing dividends and things like that, or is the best investment that's available for this cash internally within the business to continue to acquire and build that company and profit in that regard. And what we're seeing is companies having more of a tendency to use their cash right now to make acquisitions. Lots of inquiries about who's available out there. So to draw it all together, really times are great. I don't even remember the last time I heard a pessimist complain. It's just been an excellent couple of years. Quite frankly, we've all earned it because of the downturn that we all endured. And everything that we're seeing out there in the market would indicate that the recovery should continue for the next few years, be very strong. And with that, I'll take any final questions that there might be.